Okay? We will start a tape out called volatility. Brian Plain, um, you think I would know how to spell the word? Type it in the Skype volatility. Um, Volatility, I'm recording this morning at 5:24 Pacific Standard Time AM. And we are in the volatility. Yesterday morning we had a gap in the futures down 100 points, and then Warren Buffett comes out, and then the gap down was only 65 or 70 points in the futures. And to confirm volatility is the following day you get the big gap up. So you buy calls and you're holding them because of volatility. The other day, they take and strip out the premium. Today, if you have puts for the bears, so volatility is designed to put both the equal amount of risk in any forgiven holding overnight or any forgiven option when volatility is here. And the other stage of volatility, after we seen the warning signs last week, and so we seen the indexes zipping up and down like yo-yos, then we've seen the big gap down yesterday. Then we've got a counter gap today. And the same equities that were gapping down, as I said, in mathematical, you gap up mathematically just as you do down. So we were very tempted to buy at the end of day in this volatility. It's like, okay, I go to a casino and on the roulette table they got a bet. Do I put my money on red? So if the thing goes around the wheel and it falls on red, it falls on red. Or do I put my money on black and it goes around and then the number that it sits in has a black, and you get paid on either one of the two that sit in there. That's a good definition of volatility and the confirmation of the roller coaster gap syndrome. So what do? You put both money on red and black. It's going to land on one of the two numbers, and one of them are going to win. That's volatility. It's another stage of volatility that we look because of the difference of both sides of the market from one day to the next. So 2 days, we've had roller coaster gaps. This piece of shit, Google, gaps way down the other day. Today, it gaps up. Okay? Other piece of shit stocks like Apple and Goldman and all the rest of them, they gapped down yesterday, but then today they gap up. That's the definition of volatility. And it's another confirmation. So in volatility, as I've said, what do you do in volatility? Well, if you're long the market, calls on Google, and Google will go up, bam, you would be selling into it. Okay? It's going to be volatile, and that's the problem, and that's another stage of volatility. What the markets have been selling off as much as they have had, another sign of volatility is that certain stocks at very certain key levels that I did yesterday, Goldman Sachs being one, Google, and Apple, is that Goldman got sold out at the 200-week moving average at 165. So that's Goldman support. Then from there, it had another lower high of 168. And the calls still go down $1. So this volatility is to find out where the lower end of the equity, obviously Google's found support $2 below the 530 strike. But this is all volatility, no matter how you look at it. And people are not used to trading volatility. So as a trader going into anything overnight, you pick on and off at the end of the day. You buy the deflated put against, if you bought a call and you're holding it and it happened to go up the other day and it was up at the end of the day, at the very end of the day, last 10 minutes of the day, you start buying the deflated put. So if they gap it up, so what? Your call is going to gap much higher, but that's how That's the only way. There is no other way. And they're mathematically on both ends. And that's how I'm going to start the day out. I'm also going to show the gap. Baidu being the number one gap. For no reason. This is your gap list. Amazon, it's all. So yesterday, you couldn't find anything in here. They're not big gaps, just the fact that the majority of the stock market is got a gap. And that's how we're going to cap volatility. And so gap open up, you'll have gap open downs too. Right here, you still have weak stocks in the sector because we broke key levels. So you're still going to have the gap downs, but the ones that are the healthiest ones, you got Wynn gapping up $1.13. Why would that piece of crap gap up? Let alone Garmin. Why would Apple want to gap up? There is no reason other than part of this volatility is that people sell into that volatility. So if you're an owner, such as David is going to come out of half of those other calls, you sell into the gap. That's volatility. People will chase the opening on the gap. We've got an FOMC meeting this morning at 11:15. So basically, you gap up into the meeting, as they do. The markets have hit some pretty good levels of support. So those are the indexes. But better yet, I showed three stocks and I put them all on one single video. Goldman has the best support out here at its 165 in its volatility range. So obviously it's 165 to 175. So it's a 175 put and whatnot. But I just want people to know the volatility. And that it's here. So at the day, you got to put money on both red and black. So when they wind the wheel and the little ball goes around the little roulette table, it's going to land on one of those colors. And there is no other way when we start to see this. So this is going to be day number 2 of volatility. Whereas before, volatility was a one-way direction, even though I wouldn't call it, we don't even call it volatility. The gap sequences were in one way. We gap up every day after day after day, okay? And, that was that was in the cycle, but now we're back into volatility. So what people do with volatility on the opening gap, they will sell into it. What would we do? We let them go to their high, then we buy the put, just as I showed on MasterCard trade. As an example, a stock goes right up to the top. What do? They're going to take the other side of the trade out in volatility, and they're going to take the put side premium out, and then you build the put there. Then you don't buy the call because it's going to be the opposite of the volatility gap. It will be inflated and you don't buy it. You have to wait for them to pull back. Then you buy that trade. Okay? And that's volatility. Welcome to it.